Hello, my name is Adam Kahn. This is my half-assed channel. So today I want to talk to you guys about using calls and puts to maximize returns on investments. So let's start with, I'm not a financial planner, I'm not an accountant, and I'm not a lawyer. Please use any of the information on this channel as entertainment purposes only. Reach out to your financial planner, your accountant, or your lawyer for any financial decisions you make. I'm just sharing the stuff I've learned through my own experience. Um, and to be honest, the one I'm going to share today, my advice is you don't do it because it does involve risk. To give you a little bit of a background, after graduating college and getting a little bit of experience, I was a commodities trader on the floor of the exchange in Chicago at the Mercantile Exchange. Well, when you trade currencies to wield 125,000 in currency, you need $2,500. So to be fair, even at the time, I didn't understand how much risk I was taking, the margins I was playing with, and how much I really could have lost if the markets moved the way they can move sometimes. I was super fortunate, but when I look back and think about it, it's like, you're a kid, you just don't think about some of it. And there's some of those same risks with trading options, depending on how you use them. And some of the things I'm going to talk about today take on some of those risks. One being you selling options. Now, options are a little like insurance, and I want to be the guy selling the insurance, not buying it, because generally you overpay for your insurance because you're betting something will happen that is more than likely not to happen. So let's start with selling puts and the way that I use those. So I'm going to use Rivian just because I've been trading it recently. And I try to pick a stock that has a bit of a volatility to it so that it's not, I love Philip Morris, MO, Altria, that one. But to be fair, it doesn't move enough, and you're not going to get the volatility the same way you will in a Rivian or a Tesla or Snowflake or one of those more volatile companies. And if I'm going to sell premium and I'm going to sell options, I want to get some of that in there. Because when you trade options, there's time decay and other things in there that you're getting when or paying for, depending on the side you take. So Rivian closed at like $16 and change last week. If I sell a $16 put, what that means is I'm committing to buying 100 shares of Rivian if it gets below $16. When I sell that put, I get paid a certain amount of money, depending on the market, to take on that risk. So if I'm comfortable buying 100 shares of Rivian at $16, well, I'm comfortable selling that put. The negative side of that is if I'm really bullish Rivian and I think it's going way up, that by selling the put, you're just going to get what you get paid if it goes straight up and keeps going. Now, Rivian, last I looked, now earnings came out and volatility is going to be higher when that happens. Was running like an 80 or 90 vol even after the earnings came out, and that's a nice premium to be getting in an option. So I try to do the weeklies. I'll sell a 16 put or a 15 put or one of each. And I'll collect, I think last week I sold the 15 puts when it was below 16 for 40 cents a piece, and I sold 4 of those. So I collect 160 bucks. Now, if Rivian gets below $15, I have to buy 400 shares, which means I have to spend $6,000 for it. And I like to make sure I have the cash there. If you have an account that allows you to be on margin, you may not be the cash, which is why I say you are taking on some risk. And the analytics and the math that's done to come up with the prices that you're getting, these are really intricate computer programs. So if you think that it can't get to here or there, I would double check that because markets can do pretty much anything. So be prepared for it to go further than you expect and be okay with that. The reason I pick Rivian is my attitude is, well, if it keeps going lower, I'll be willing to take that loss the same way I would be if I bought a stock I really wanted to own. I have companies like Amazon and things like that in my mind, I just want to own them and I don't even look at it, and I kind of put it in a mental, it's in the vault. But I do trade as well. So Let's say Rivian closes below the strike price, which is the 15 in this example for it, on Friday when those expire. Well, if I get assigned those 400 shares, I can then reverse and start selling the calls against it. Maybe I go a dollar higher, however I choose. I still try to stick to the weeklies, and I try to stay within my limits of what I'm comfortable, because if I get filled on those 400 shares, I still want to be comfortable selling more puts. I have to make sure the account has enough money in it that I can continue to keep trading and selling the premium as the stock moves up and down, and recognize that sometimes it gets really directional and you'll just keep getting more and more stock. So you have to stay within a reasonable amount of shares for what you can afford to buy. Now, same to the other end. If you sell the calls against it, you get paid for selling the call and you collect that money. We reverse and we were filled at 15 and life works out perfectly and we sell the 16 call now, and maybe we collect a little bit more money for that week. And if the stock goes above 16, we've now committed to selling the stock. We would get the money at that price and be able to move on to the next trade. Things never worked out perfectly. I mean, they might from time to time, but on a consistent basis, you have to ebb and flow with the market, and you have to pick stocks that you're comfortable owning, because if they get directional to the downside and you continue to get assigned more shares, as you're selling the calls, if the stock continues to drop, what you're going to get for the premium on the call is going to be less money as it continues. The way I handle that is I start looking out further dates, because the further out you go in an option, the more you'll get paid because the time decay. Now, you're not necessarily really getting paid more, because if you went from a weekly option to a monthly option, well, instead of 1 week for that option to get filled or go past the strike, you're now giving 4.25 weeks, or 4.14 weeks for the month, and that changes the timeline. So while it might feel like you're getting more because you're actually getting, I'm making up numbers, I'm not looking at a screen. Let's say for a monthly option you get 80 cents, but for a weekly you only get 20. Well, you've got all that additional time that the markets will move, which is why you're getting that additional premium. And if you think about it as return on investment too, if you're multiplying every week, well, obviously that'll add up to 4 weeks. And if you're only getting paid once a month, well, your return might be less, even though the dollar amount is more. Works really well so long as it's companies you're comfortable owning and holding. Just be patient. Don't overdo it. Stick to basics. Is the you want to have a few companies you keep an eye on that you're comfortable with, and I would start with just one and make sure you're having success with that before you worry about another. Because what I found as I moved from the floor to a computer, I can get a little overwhelmed by watching too many stocks. If I stick with one that I'm trading, maybe a second one, I get a very good feel for the moves and I don't have too much worry when they go up or down, when earnings come out, if they get really crazy. I actually like that for selling the options. I would rather a stock moving around a bit, especially when I'm comfortable with. Um, and then I have, as mentioned, I have the ones I just own, and I stick with those too. If you use the strategy, really, I would suggest trading a little bit more with the one stocks you're comfortable with than spreading out to 10 and trying to get comfortable with all the different movements. Because what you'll find is this one's up, that one's down, and you'll lose track. And I find it's really difficult to stay disciplined. Also, keep in mind, I break all the rules I say, which is why I say don't follow my advice. When I think about trading on the floor and the things that we used to do, I mean, they talk about if you have a losing trade, you don't add on to it, and this and that and the other. My God, I think I made a living by adding on to my losing trades. It was a terrible way to do things. So I just feel like I was really fortunate then. I try to stay super disciplined now. In some ways, I can't help but trade just because that's how I made my living and grew up doing it. But I keep my trading account really small and very, disciplined. And I try to put my main investments somewhere else so that I don't watch them too much. my best advice is just keep putting away and putting away and putting away and hope that it grows enough. But this passive income stuff that people talk about, my God, none of it's passive. Eh, Passive means somebody's going to take it. Like, that's what I see as passive. I don't care if I'm doing real estate or stocks or whatever. I got to pay attention. There is no such thing as going to sleep on a beach and your money working for you, unless you've got so much money that at 2% or 3%, you have plenty coming in per month. And sure, if you want to buy, like, I wouldn't even trust a 2-year treasury at a higher rate than a 30-year, if that's what you mean by passive. I don't want to be looking at 30-year treasuries that can pay my bills. And yeah, sure, then I could call it passive. But, you know, it's a big amount of money depending on your lifestyle that you would need getting 2-3% to be really passive. And outside of that, you got to pay attention to your money. You got, and what I advise people is learn about it. Don't just hand it to somebody else and think that they'll take care of it. Take a little time. It's important. Learn about your finances. You don't have to be a genius at it, but just have some general ideas of what you want your money to do and how you want it to work. If you guys are watching because you want to sell calls and puts, I'm happy to answer questions about it and give you some advice. I watch a lot of the different stocks, so I might have some feel for it. But to be fair, my general goal is that people just put away and save. Those of you who trade, though, it's fun. I love selling options, and you can do real well. And yes, you can create a weekly or a monthly return. I set a goal of a certain amount of premium I want to sell every week, and then I make sure that I've sold that. And to me, I think of that as income coming in as long as I sell the premium. I get paid that. Now, I might get assigned some stock or I might get some stock that's taken, but as long as that premium sells every week, I should be okay. So I hope you enjoyed the content. If you want me to talk more about options, I'm happy to discuss calls and puts. Happy to talk the futures markets and Forex. Like, I love the currencies. I still trade those in stocks or whatever. Give a like, subscribe. Don't. I'm cool either way because, like I said, I'm kind of having fun. I have a cooking channel that I'm doing that's real fun for me too. And markets, my God, it's what I do for work. I'm probably going to talk them either way. I might as well put the camera on and record it a bit. So maybe you like them, maybe you don't. I'm good either way. Have a great day. I hope you're all enjoying your weekend. It's chilly out here in Las Vegas and even a little bit overcast. I mean, I can see my eyes look a little dark, but pretty pretty cold day for us out here. So enjoying my new microphone, my little thing that starts and stops the video. Again, I hope you guys enjoyed it, and if not, that's okay too.